Hi, everyone. Welcome to TP Talks, PwC's Global Transfer Pricing podcast series. Our episode today will cover taxing digitalization. My name is Dana Hart, and I have three fantastic speakers who will be covering this topic. First, I have Amir Rafiq, a tax policy and transfer pricing partner in our PwC London office. Amir will be moderating the discussion today. I also have Will Morris, PwC's Deputy Global Tax Policy Leader, and Georgia Maffini, a tax policy and transfer pricing senior manager in our PwC London office. Amir, I'm going to go ahead and hand it off to you to kick off the discussion.
Thanks. Hello, everyone, and thanks for joining this podcast on taxing digitalization. Today, we're going to be talking about the work that the OECD has been doing around the tax challenges of the digitalization of the economy. At the heart of the debate really is the allocation of taxing rights, source versus residence, which has long had an established practice in the international tax system. This work is looking at how this gets fundamentally reformed and is likely to be one of the most significant changes in the international tax system for a long time. The question that is being asked is whether the current tax system is fit for the future or needs significant reform. This is effectively the start of the process. You may recall that this debate on digitalization was started at the time of the BEPS initiative under Action Item 1. At that time, it was felt that this could be addressed through changes from the other BEPS action items. However, this work has subsequently continued, and last month we had the first meaningful output from the OECD through the Inclusive Framework since they delivered an interim report in March last year. Although the recent output does not agree on a result, they have put forward a number of proposals on a without prejudice basis that they will continue to analyze further. Finally, the 127 members of the Inclusive Framework have also committed to continue working towards the final report in 2020 aimed at providing a consensus-based long-term solution. Today, we're going to discuss a number of areas which will include what the proposals outline, how countries are reacting, what the proposals actually mean, and what we can expect in terms of next steps. I'm going to start with Will. Will, what are the main points of contention and how much progress has been made under the OECD's task force in reaching a consensus view on this?
Thanks very much, Amir. So, a couple of great questions, and I think the first thing to emphasize is this is a huge project, and the timeline is really very quick. And if we look at where we've come in just the past 3 years since BEPS wrapped up, I think the scale of the challenge in front of us becomes apparent. So 2015, the OECD makes its BEPS recommendations. Action 1, which is on the taxation of the digital economy, basically says we can't ring fence the digital economy. We're going to park this issue. We're going to send it back to the folks who look at PEs, the folks who look at transfer pricing, the folks who look at treaties, interest deductibility, hybrids, all the rest of those things. We're not going to do this. But even as they're saying that, unilateral actions are beginning. We think of the DPT, for example, in the UK, but there have been things around VAT in a bunch of countries, virtual Ps in some countries like Saudi Arabia, a whole series of actions which have been triggered by the digitalization of the economy, but which go broader than the issues that the task force itself looked at. And indeed, what I think, as you've already said, and as Dana said right in the introduction, this is a project which is now larger than tech, as sort of narrowly defined as we understand it, even though those remain some of the targets of it. So this is about, businesses across the piece, across all sectors which are digitalizing, and that's why, it's such a large project, but it's why it's such an important project. And the point at which we now find ourselves with the OECD having come out with this consultation document, consultations coming up in March, a public consultation in March in Paris, we're now faced with 4 ideas. As you said, they're entering into this without prejudice, which means that they're not agreeing to agree. So this is not, this is not the basis of a recommendation. This is not a proposal. These are currently 4 ideas. But the 4 ideas that they're looking at are reverse order to which they do them. BEPS 2.0, so that essentially is a minimum tax and or a denial of deductions on payments made from countries to low tax jurisdictions or no tax jurisdictions. And then, again, as you said, looking at these questions around nexus, that's the right to tax, and attribution of profits, which in this case actually means the reallocation of taxing rights because it is bigger than transfer pricing. They've said they're going to go beyond transfer pricing. And in that space, again, we have three ideas. We have the UK idea, which many of our listeners will be familiar with, active user participation, which essentially is just about the digital economy. It's looking at how users on social websites, in marketplaces, how their interaction with the algorithm potentially creates value. It's a much broader proposal put on the table by the US and supported by others, which would look more generally at allocating income, residual profit in this case, to jurisdictions. And they're talking about using that by way of marketing intangibles in a way that does go beyond the arm's length standard, but potentially is much broader than that. It is much more about residual profit allocation in the end than about marketing intangibles. And then an Indian idea, which came in at the last moment, which is again very close to their significant economic presence, which is to say a virtual PE. Then using formula apportionment, so looking at the system-wide profit of the whole entity, of the whole group, and allocating that on a fractional basis. So as I said, this is now not just about tech. This is about all businesses, and therefore, all businesses need to pay attention to this.
Thanks, Will. The OECD had released a 2.5-pager, obviously, in February, and then they further released a consultation document. Do both of you have a view as to whether the consultation document has added or clarified any of the existing statements made earlier in the month in that 2.5-pager? Maybe if I can start with you, Georgia.
Thank you, Amir. I think that the consultation document that we have recently seen has the merit of describing and clarifying the various proposals that are on the table at the inclusive framework. But the consultation document seems to me a bit of a step back, really, with respect to the policy note issued by the OECD on the 29th of January this year. The policy note gave a sort of a unifying view of the three proposals under Pillar 1. So these are the three proposals which, in slightly different ways, as Will has just told us, try to allocate more income to the market jurisdiction. So the January policy note really gave the impression that the technical work at the OECD was bringing these three proposals together. But with the consultation document, it's much less clear whether this technical work is happening now and whether the technical work is advancing and how it is advancing. So really, it's a bit of a mixed impression if we look at the consultation document and the policy note together.
Will, do you have a view on that?
Yes, I mean, I agree with what Georgia has said. I think, on the other hand, for most people, the consultation document gave a lot more detail about these proposals than had previously been available, or in some cases even thought about. And something which we may touch on again later, for example, is that, for example, the tone of the document when it talks about the marketing intangibles does make it seem as though that may be focused much more on B2C than on B2B. I think for people that was a new detail, a new point to work into their thinking. I think likewise with the sort of global base erosion, the BEPS 2.0 idea, I think many people had thought that the minimum tax idea, which looks very much like US GILTI, not completely the same, but more like it, would be the default provision, and that the deduction denial, which looks a little like US BEAT, but not, again, completely the same, that would only very much be a backup rule. There is language in the consultation document which indicates that you might go both of them in many cases. So I think that there is now a lot more detail for people to get their arms around and try and understand and try and think about how this affects their business and therefore what this would mean for them. So I think, I think there is more detail. I think obviously much more detail is still needed, but I think this has allowed business for the first time to begin to envisage how they could be affected if one or more of these proposals was actually, brought into effect.
So, Georgia, it sounds like from what Will is saying, there has been helpful detail, although, more clearly needs to be forthcoming. We understand that the project has been worked on for some time now. Where do you think there is commonality, and where are the differences in terms of the work done so far?
Yes, thank you. I mean, this is a very important question. I think that could give us really an idea of where the final outcome of the negotiation could be. I would start from the difference first, and I think that the difference in the proposals under Pillar 1, so those that are allocating more income to destination, lies mainly in the scope. For example, the UK proposes to ring-fence these changes, this move to destination, to highly digitalized businesses. What are these highly digitalized businesses? The UK proposal seems very specific about that and states that 3 types of business models should be in scope. These are social media, search engines, and online marketplaces. The U.S. marketing intangibles proposal instead seems much broader, and as far as a group as marketing intangibles, it could be in scope. So potentially, the entire economy would be in scope of the U.S. proposal. So the public narrative is that the UK proposal ring fences while the US proposal catches everyone, almost everyone. But I think that a more in-depth analysis gives us a very different picture. If you think of how digitalization is allowing businesses to interact directly and more actively with their customers, the UK proposal could catch more and more traditional businesses, traditional companies. For example, here in the UK, we have observed a lot of our clients that offer forums or platforms where their clients can interact to discuss or improve the product of the company. And these offerings really look like social media. So this is to say really that the UK proposal could become much wider than initially envisaged. On the other hand, and depending clearly on the specific design features, the marketing intangibles proposal put forward by the US could become relevant mainly for companies with valuable brands, trademarks, or trade names, and maybe a very high level of marketing expenditures versus other expenditures such as research and development. So really we could conceive a scenario where the marketing intangible proposal is relevant mainly for consumer goods. For example, if, as Will has said, B2B is excluded from this proposal. So this is a scenario where the marketing intangible proposal also ring fences. So the final outcome of each proposal on the table could be very different from what an initial analysis would suggest. The convergence between the proposal is mainly in their final aim, as we were saying, so in the fact that they all want to allocate more income to the destination where the customers are, but without going to a full destination system. And this is probably where the convergence at the technical level can bring the 3 proposals together.
Thanks, Georgia. Georgia, I think you've mentioned, obviously the UK and the US have been involved in a number of these proposals, and we know that the other ones also have champions, including Germany and France. Well, is there any additional insight you can give to the positions taken by these countries under each one of the individual approaches that have been put forward?
Okay, thanks, Amir. So let me just build on some of what Georgia said. But let me also throw India in as well, because the significant economic presence idea is now part of the consultation document. So the US, obviously as the home of the large digital companies, tech companies in the world, has a particular interest, which they've expressed for many years, in not having the digital economy ring-fenced. But they do also, as was shown in tax reform, believe that there are things about the international tax system, international tax rules, which need changing. So the US position is driven both by its interest in not having digital companies ring-fenced, and also at the same time about conforming international tax rules to some of the changes in the US tax rules. The UK has been relatively clear about this. I think it views the problem as essentially being tech companies not paying their fair share, and therefore its proposal very much ring-fences the digital economy. Now, there is a concern, not just in the UK, but also amongst France and Germany, if we're talking about those countries, that the US idea could go all the way towards pure destination-based taxation. And that in turn would hit export economies very hard, including the UK, France, and Germany. So they have concerns about the US proposal, and the UK proposal is an attempt to ensure that that doesn't happen. The French and the Germans have that concern about the marketing intangibles idea and the fact that it could go too far. But they also say, look, there are other issues in the international tax system, and we feel that BEPS is an unfinished project in that context, and therefore we want to look at this minimum tax idea. Now, there are all sorts of EU issues around that, for example, but we also want to look at this denial of deductions idea, particularly where countries don't adopt the minimum tax idea. And that, in fact, has its genesis in a German rule called the license barrier rule, which relates to essentially denying deductions on payments to non-compliant patent box regimes. And then the Indian proposal, which they brought forward on behalf of the G24 with Colombia, actually represents the point of view of developing countries, large developing countries. But there, essentially the idea, this goes much more back to the idea of source versus residence, rather than maybe destination versus residence. And in that case, they're saying, firstly, we need to have the right to tax any income which arises in our country. And therefore, the nexus rules are too strict, the PE rules are too strict, and therefore we need to reduce those. And then having done that, we need to look at the system-wide profit of the entity in order to truly allocate that amongst countries. So, a more radical idea. But it represents essentially the economic positions of all the countries involved. And I think it's important to bear that in mind as this goes forward, trying to see where agreement might be reached between countries.
Thanks, Will. Georgia, Will's mentioned the developing country and G24 perspective in particular. What additional detail can you give us on this?
Yeah, it seems that apart from the proposal that has been tabled at the OECD and that Will has described, some non-G7 countries and some developing countries are moving unilaterally as well. For example, we have Chile and Brazil that have discussed the introduction of a digital services tax, so a turnover tax on digital services, even if the progress is a bit slow there. Pakistan has suggested a digital services tax too. Turkey has recently implemented a withholding tax on digital advertisement at a very high rate, at 15%. So there is a lot of movement in terms of unilateral measures also outside of the G7.
Okay, I think that's been a very useful insight into what's been proposed and how the different countries are feeding into each of the proposals. Now, perhaps just moving tax slightly, it might be useful to do, Georgia, is maybe just tell us the ways that we think transfer pricing is going to be impacted as a result of all the potential changes. Will alluded to this at the start, but maybe we can dive into a little bit more detail on this.
Yeah, Amir. So transfer pricing is really at the core of what is being discussed at the OECD. It's also true that, having said this, so apart from the declaration we have seen in the consultation document that countries of the inclusive framework are ready to move away from the arm's length principle, we have for the moment very little detail on how the proposals could be implemented technically, but we have some points that we understand quite well. And the first one is that countries of the inclusive framework are considering formulaic approaches and residual profit splits methods to allocate more income to the market, with many countries liking the formulas because of their alleged simplicity. The second point is that the move away from the ALP seems to be ring-fenced for the moment. So it would be limited to income arising from marketing intangibles and user contribution. But clearly, this will have a knockout effect on the overall allocation of income within a multinational group. The question here is clearly how sustainable this ring fencing is. So the risk is that the new approach will then be applied to the entire profit of the group. And this risk really increases if the new approach is a formula that is not rooted in the economics of the business, but a formula that is unprincipled. So in that case, because there is no economic principle underlying what we have agreed, the formula we have agreed, you can imagine aggressive jurisdiction having an incentive to really claim that that formula does not allocate enough to their territory, so the system would become very unstable. So I think that because transfer pricing is really at the core of the discussion, we should expect quite important changes in the short term, but also in the longer term, if the system is unstable.
Yeah, and Georgia, it certainly sounds like there could be some fundamental changes on the way if this is implemented. Well, you mentioned a little bit about Pillar 2 at the start, and it might be worthwhile just to get a little bit more insight into this. Is this something that we can expect to move forward? Is it going to look more like the US system of guilty, or is it going to be more akin to the German measures to deny access royalties? What's your overall take in terms of the expected outcome of the Pillar 2 proposal?
Thanks, Abir. So it is clearly a proposal which has legs. I mean, I think of the four proposals out there, the conventional wisdom, at least at the moment, is that the marketing intangibles on the nexus and profit allocation side is the, sort of the one that will get the most serious work. But likewise, also the Pillar 2 does, and there are the political reasons for that. The French have the G7 presidency this year. The French finance minister has said they'll push this forward. We know that the Germans are also keen on it, and those are two major players at the OECD in the G7 and in the G20. Which of the ideas predominates, we don't know. And indeed, as with all of these things, there is the possibility that we get everything in the end. There's nothing which says that we'll only get one. And again, I think people need to bear that in mind. So there are some interesting points about this which are worth bearing in mind. And again, as we said earlier on in this podcast, while there is more detail in the consultation document than there was in the policy document, there's still not a huge amount of detail, and therefore we have to exercise our imagination. So on the minimum tax, there are some really important procedural questions. It sounds like, from the way that they've described it, that unlike guilty, which is where the minimum tax rate, the overseas tax rate, the foreign tax rate, or whatever you want to call it, is calculated on an aggregate basis, which is to say all the taxes from across the world on all the, in the US case, non-US income, comes up with whatever the effective tax rate is. There are indications in the document that, in fact, this would be done on a country-by-country basis. This was considered in the lead-up to US tax reform and essentially rejected because of complexity. But there are also economic efficiency issues and various things around that. So country-by-country is one thing. There are tricky questions around how you actually calculate an ETR, what do you do about things like timing issues, for example. In fact, how do you define income in the first place? Whose accounting standards get to prevail? Do you calculate all this stuff at the headquarters level, or do you do it lower down in the chain? There are a bunch of really tricky design issues which are in no way addressed in the consultation document. So those will come out. Likewise, on the denial deduction side, we have this model in the German license barrier rule, which shows us how it works with one particular stream of income, generally going to one country where it's quite easy to work out what the effective tax rate is because it's the patent box rate. How this would work more broadly, where there are multiple questions involved, multiple countries involved, again, potentially different standards, again, timing issues. How would you make all of this work? And is it right? Is it the appropriate thing to do to link this with the first pillar, or should one be only a secondary rule if the other isn't accepted by various countries? So again, a lot of questions around that. But as American listeners will know in particular, the minimum tax generally ends up being a floor. It is in no way a ceiling. And depending on how it's calculated, particularly with a country-by-country calculation, the actual effective tax rate of most corporations could end up being many percentage points above what the minimum tax rate itself is. But we do know that some of the countries who are thinking about this say, well, it has to be country by country. Otherwise, you're going to average your tax down out of ours. So a lot of really important questions to which at the moment we don't have answers. But again, people should be thinking about that.
Yeah, I mean, it certainly sounds like there are some fundamental design and implementation issues still to overcome under that approach. Georgia, I would suspect that most multinationals probably recognize something is going to come in and are very much focused on not having double taxation. Is either approach going to be less risky, and what's your view on the prospects of double taxation?
I think, Amir, that unfortunately it's probably safe to assume that both the income allocation proposal, so Pillar 1, and the minimum tax proposal, Pillar 2, and importantly, their interaction will increase substantially, at least in the transitional period. the risk of double taxation in the system. Think, for example, of the marketing intangibles proposals. Will told us that this is probably under Pillar 1 the most likely proposal to go forward. So if we want to allocate more to the market, clearly somebody else in the group will have to give up that income. So assume it is the jurisdiction of the principal. In that case, double taxation disappears only if there is an agreement between the jurisdiction of the principal and the market jurisdiction. The income will be taxed only once, and now it will be taxed in the market jurisdiction. For this to happen, you need a lot of goodwill in the system. You first need broad agreement about the new system by many countries or by enough countries. Then you need to change the treaties, and then you need to reinforce the system with dispute resolution. So to create all this, it's a lot of work, especially in the short time frame set by the OECD, by the G20. So at least in the transitional period, I think we should expect some double taxation, some complexity, some uncertainty.
Will and Georgia, maybe to you, Will, first. Given everything that we've just heard, is more tax controversy just a foregone conclusion then?
Well, hopefully not, but quite possibly. I think one of the important things to recognize about this project, unlike BEPS was anti-avoidance. BEPS was about untaxed income, stateless income, double non-taxation, all the rest of that stuff. It was about essentially a pot of money which was untaxed and into which countries could reach their hands. And everybody was a winner, or at least every country was a winner. In this case, when we're talking about the reallocation of taxing rights, which is what we're doing in Pillar 1, in the nexus and profit allocation one, we're talking about one country's a winner. Almost by definition, another country has to be a loser. Countries don't like losing revenue, even when it appears to be good tax policy. So I think that we will see resistance, even if there's an agreement. We will see some resistance to doing that. So I think we can expect to see more controversy. Likewise with BEPS, if there are very detailed rules, or indeed if there's agreement without detailed rules, again, I think we can expect to see, quite a number more of disputes. So I would expect, yes, we would see more disputes going forward, as a result of discussion of these ideas and then their subsequent implementation, assuming agreement.
Georgia, are you more optimistic or less optimistic than Will?
No, I think I will have to agree fully with Will, especially that if we agree on a formulaic approach that is not linked to the economics of the group, of the business. The answer is generally to create a sophisticated dispute resolution system, but we have to remember that a system that is held together by dispute resolution mechanism is not a stable system. The stability of the system should be based on its design features, and not on an overlaying sophisticated system of dispute resolutions. And we know that disputes bring uncertainty, high transaction costs in the system.
Obviously, when we talk about dispute resolution, I think it's important to note that a number of the countries involved, it's only really hinted at in the consultation document, but certainly from speaking to the OECD, they do understand that we're going to need to step up on dispute resolution, and given that some of these proposals would probably require treaty changes, that would give you a chance to reopen the dispute resolution mechanisms in treaties as well. So, we shouldn't be too pessimistic. Yes, there will be more disputes, and we should do our very best to prevent the disputes from arising. But there is also the possibility of better, more streamlined, stronger, more timely, etc., dispute resolution coming as part of this package.
Thanks, Will. It certainly sounds like, given everything that we've heard from both Will and Georgia today, that there's still a significant amount of work to be done, a significant amount of detail to be ironed out before we can move towards implementation, and that in itself still requires a lot of work to be done. Where does the OECD go from here, and what can business do to get involved?
Right. So the timeline is that there's a public consultation in March. We know that relatively detailed comments, not hugely detailed because they're only responding to the amount of detail that the OECD has put out, but that relatively detailed comments will be filed, have been filed. After the consultation, the OECD will go away, will work with the countries, work with the task force, but also with the steering group of the inclusive framework, because this is more now than the task force on the digital economy. there is a G20 meeting in June in Japan, at which they will, we understand, present a work plan for moving forward for the year and a half beyond that. So there will be an inclusive framework meeting late May, early June. There is going to be a chance throughout all of this for business to have input. The OECD, I think, will be open to hearing from people, but national governments, who the OECD do tell us are much bigger drivers of this project than they were during BEPS. National governments, whether it's the US, whether it's France, whether it's Germany, whether it's the UK, whether it's India, all of the countries which have been involved in this, it will also be worth business, local businesses, but also, inward investors speaking to those countries as well. So there will be that opportunity. And we've then been told by the OECD that after June, in this year and a half period of, getting into more detail on this, that there will be further opportunities for public input, for public consultation, but there will also, I think, be many, many opportunities, as there were during BEPS, for businesses to talk to the OECD, hopefully for these ideas to get road tested. And, I think there will be as much opportunity for business to engage as business which wishes to take. And certainly my advice would be for business to take as much of that opportunity as they can do.
Thanks, Will. And now maybe just moving towards, I guess, the final part of our podcast today. Just a question to both of you. In terms of what clients should be thinking about and how they should be preparing for what may come, what should they be doing both within and outside of the digital space to get ready? And maybe if I could start with you, Will.
Sure. So, again, it goes to what I was just saying. Part of it is really engaging with the policy process. I know, as you know, I'm based mostly in the US. I know from talking to US clients, to US businesses, that they are still very focused on US tax reform, as indeed they have to be. Thousands of pages of regulations coming out. The need to comment on those, moving from proposed to final. But at the same time, this project, this digitalization of the economy project, is very real. And the impact that the changes in foreign rules could have on businesses is significant. So it needs to be a focus of attention. So stay engaged with the policy process. But I think more than that, as more details emerge, which they will do, we believe that there'll be a Treasury white paper at some point in the next period of time coming out, which will give more details on marketing intangibles. Obviously, the documents that we'll see late May, early June will have those details as well. Is thinking about how does this affect my business model? How does this affect how I do business? It needn't be full modeling out, but it should be trying to interact with it because, governments, having sat in the government chair, I know this, you cannot imagine how every business works. You may have difficulty imagining how any business works. So business needs to inform that process. But, the other important thing to bear in mind is the nexus and profit allocation part of this is not an anti-avoidance project. This project is meant to be about, as the economy changes, how should taxation systems change to get revenue, but at the same time to do that in a way which doesn't dampen business, which doesn't dampen cross-border trade and investment. So again, business needs to inform how that might happen. And, as we said right at the beginning, change is happening. I think most businesses accept that, but that change can be done in good ways. It can be done in ways which comport with the way business is being done, the way the business may change. And it can also be done in ways that suppress growth. And that would be a tragedy because we need that growth.
Thank you, Will. Georgia?
Yeah, on the more, maybe I'll focus more on the transfer pricing side. And I think that there is still a lot of uncertainty of whether the proposals around income allocation will go forward, which one will go forward, even more uncertainty around the design details of the proposal. But having said this, it's clear that what is being discussed at the OECD will have an enormous impact on the way we do transfer pricing. So what we are telling to clients now is that they really should monitor very closely the discussion that is taking place at the OECD. And as Will has said, that they should engage with policymakers because there is still room for having an impact on the discussion. What we are doing at PwC now is talking to clients and make them aware that the discussion is relevant, it's very real, especially for those businesses that are not really highly digitalized businesses or that don't perceive themselves as highly digitalized business. We are telling them, look, the proposals will have an impact for you as well. For example, where you have a limited risk distributor-like structure in place. So, and as we keep following this discussion, we will be able, I think, in the future to give more concrete assessment of the situation and of the impact on our clients. But overall, we are really following the discussion very, very closely.
Thank you, Georgia. I'd like to thank both Georgia and Will for their very valuable insights into what is a very complex topic on taxing digitalization. If I am to give a personal view, I do see this as one of the most fundamental changes we are having to the international tax system, as I outlined at the start of the podcast today. One of the things I've observed, having followed the OECD for about 20 years, and particularly very closely in all the BEPS work in the last few years, is that the rate of change has increased massively, and the desire to get things done is probably at an unprecedented level compared to where we may have been 15 or 20 years ago. And I think the will to change things and to implement new ways of doing things is clearly there, and we've seen that as a result of the BEPS work, and now we're seeing that as a result of the work on digitalization. I do think we do have a few more twists and turns to come in the coming months, and I'd encourage everyone to stay connected and to input in, as both Will and Georgia have outlined. Thank you again, and with that, I'm going to pass you back to Dana.
Great. Thank you, Amir, Georgia, and Will. That was a very insightful discussion. I want to thank all of our listeners as well. If you would like further information about this topic, please contact the speakers. You can find their contact information in the description of this episode at pwc.com/TP Talks. Thank you.